Good afternoon, ladies and gentlemen, and welcome to the MERCIA Asset Management PLC final results investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investment Meet Company dashboard, and we'll send you an email to notify you when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you could give that your kind attention, we would be most grateful. And I'd now like to hand over to Mark Payton, CEO from MERCIA Asset Management. Good afternoon to you, Mark.
Thank you, Mark. Good afternoon, everybody, and welcome to MERCIA's 2021 preliminary results. For those that we have not met before, my name is Mark Payton, Chief Executive for MERCIA, co-founder of MERCIA back in 2010. 20 years of experience in predominantly life science commercialization and investing. Also supported Native Antigen Company, made the first investment and grew that, as well as Oxgene. On my right is Martin Glanfield, MERCIA's Chief Financial Officer.
Yeah, good afternoon, everyone. I joined MERCIA just under 7 years ago to actually help Mark float MERCIA. And my background is the CFO of technology-enabled public and privately owned businesses.
Julian.
Yeah, good afternoon, everyone. I'm Julian Viggers, Chief Investment Officer. I've been a fund manager across MERCIA's venture funds for the last 15 years or so. In that time, overseen many IPOs and trade sales, including software business Blue Prism, where we were the first investors back in 2004, investing £1 million, and ultimately returning a total of 95 million in returns as we sold that asset down post its AIM listing.
Thank you. So slide 4 nicely really summarises what has been a strong and positive year for us in this reporting period, with assets under management rising from 800 million to 940 million, so that's 18% rise over the period. Adjusted operating profit at 3.3 million, and I should just point out that that excludes performance fees, realised gains, and fair value movements on the balance sheet. In terms of realised gains, we've seen 20.3 million, that's up from nothing last year. And in terms of our direct investments fair value movements, it's been a positive 10.1 million versus a negative 15.8 million loss last year. Liquidity is very important for any investor in the market. 314 million pounds in unrestricted free cash across the group is an exceptional place to be in terms of making new investments as well as supporting existing portfolio. And that's broken down into 259 million across our third-party managed funds and nearly 55 million pounds cash on hand on our own balance sheet. And there is no debt in the group. And in terms of that no debt in the group, the business has traded extremely well during this difficult period. We've made no redundancies, no use of furlough, no use of C-bills either, and the business has continued to deliver. And against that concept is the fact that we had three-year strategic objectives set 2 years ago in 2019, all of which have now been achieved ahead of schedule, a year ahead. That was to grow assets under management from 500 million to 1 billion, move the group from loss-making to a sustainable, profitable position, and to evergreen the balance sheet. And by evergreening the balance sheet, what we mean there is investment realizations, cash realizations from balance sheet activity exceed our run rate in terms of investment activity. ESG is something we often hear about in the press. It's something that's at the heart of everything that MERCIA does, including our investment philosophy as a regional investor with the mantra of responsible employer, responsible investor. ESG is an important part of our operation. And it's pleasing also to report that we started our initial maiden dividend at our interims, 0.1 pence per share. We're upping that at our prelims to 0.3 pence per share. So that's 0.4 pence per share over this reported period. And in effect, what MERCIA does is three particular areas that we focus on: find value, add value, extract value. Find value, we're a regional investor embedded in the regions across the country. We've seen something like just under 3,000 inquiries And importantly, of the 170 plus companies we've backed in this 12-month period, over 70 of those were brand new to us. And that's important as we continue to build momentum across the group by growing the portfolio. And the portfolio is in excess of 400 companies now across the group. Add value is what we do in terms of being a proactive investor. We're over 100 employees now, strengths in sector disciplines, etc., but also centralized resources. We do searches for C-suite, for senior managers, non-exec directors and chair through a team internally, and that is at MERCIA's cost, not the portfolio cost, as we look to grow those businesses. And back to making those new investments this year across the regions, our investment activity has created 467 new jobs across the regions, which I think is a great place to be when it's such a difficult trading period for many. We've seen 10 profitable exits, so in terms of extract value, we're continuing to do that, 10 profitable exits across the group. That's up from 5 last year, and that momentum continues into this year. Just to remind you what the addressable market is that we're looking to exploit and grow. It's the small to medium-sized enterprises. These are businesses that typically are employing less than 250 people, and when we're investing, usually it's somewhere between 5 and 50 people at our initial investment. They're predominantly private businesses, and we're investing anything from £300,000 up to collectively across the funds and balance sheet to 10 million. And these are into businesses that typically lead less than 20 million in their total finance. And the reason why that's quite important is that when we come to sell these businesses or list these businesses, they are at enterprise values of somewhere between 20 million and 200 million. And actually, if you look at those 10 profitable exits that we've made, they fit within that range. In terms of market penetration so far, we've taken about 3% of the regional equity market, 0.3% of the debt market, so plenty more to go off. So we remain focused on the regions and on the UK. The model that we're operating is a hybrid investment model, third-party funds combined with proprietary capital. A majority, over 700 million of our assets under management are in our third-party funds. These support the businesses across private equity, debt, and venture capital. Our proprietary capital then co-invests with these funds or invests in portfolio emerging from these funds. And just to repeat what I just said, there's over 400 companies across the portfolio, approximately 23 on our balance sheet. So a very selective approach in terms of balance sheet capital work. The other point of the balance sheet proprietary capital is selectively we're a limited partner, an LP, in a number of the funds that we manage. That's important when we're trying to grow places where we're doing well or looking into new regions that we want to exploit in terms of our early stage funds. And of course, the other function of our proprietary capital is that of being used for acquisitions as we look to grow ourselves beyond organic. Which takes us nicely on to the next slide that just shows our own growth. So our portfolio are performing well and growing well, and we would argue so are we. And this is from our IPO through to this financial year and our declaration of our initial dividend. And you see on every metric, our growth during that period, that 6-year period, has been, I think, quite admirable in terms of turnover. It's gone from 500,000 to over 19 million. Assets under management from 100 million to 940 million. Free cash, for instance, 53 million up to 314. Strong growth driven by organic growth in terms of fundraising, but also through acquisitions. In 2016, acquired Enterprise Ventures, and in 2019, we acquired the fund management contracts of the Northern VCTs from MVM. And to reflect the maturity of MERCIA as it grows, it too has a mature share register, a very broad share register, a deep share register, and one that's there to support our own growth as we go forward. You'll notice that there's a lack of concentration in any one institutional holding, and the largest actually is that of the board, management and employees grouped together with a 17% ownership of the business. And that, I think, presents very strong alignment with our other owners of MERCIA. So we've achieved our 3-year strategic objectives a year ahead of plan. And so management team and the board met, and we try to work out what is an ambitious hurdle for us to head for the next 3 years. And this is where the MERCIA 2020 vision has come from. And by this, what we mean is 20% growth in AUM year on year over a 3-year period on average, and a 20 million pre-tax profit year on year for 3 years again on average. And the reason why I stress average is on the one side, we've got a very profitable fund management business that's contributing towards, in fact, delivering the progressive dividend policy that we have developed and are growing. Then on the other side is really the balance sheet activity through realised gains and fair value movements, which provides, I guess, what one would describe as, super profits for the group. And that is less dependable in terms of occurrence, but we would expect over the 3-year period to be meeting and beating that 20 million per annum pre-tax profit. Thank you. Martin.
Mark, thank you. Notwithstanding the challenging year that it's been for everybody, I'm pleased to say that MERCIA has come through unscathed, and these results reflect that fact. And it's also, I think, worth noting that throughout the entire year, almost all of our staff have been working remotely. So these results are a great tribute to their efforts as well. As you can see, we've increased revenues by just over 50% during the year. And that's quite good news, not least because our operating costs have only increased by 28%. So notwithstanding lockdown, the benefits of operating leverage have still been invisible. As Mark mentioned, we achieved adjusted operating profits of 3.3 million, again, a significant increase on the prior year, but that excludes the net performance fees we've also received of 3.8 million. And those fees have come from the strong performances of both the VCTs and also, for the first time, our EIS funds. Those profits and fees, plus the realised gains and fair value movements, have resulted in profit after tax of 34.5 million, which is some 52 million, believe it or not, better than the prior year 17.5 million loss, which of course was 8 days into the pandemic. These encouraging income statement performance leads to net assets increasing significantly to 176 million from 141.5 at the prior year end. And as a result, I'm pleased to say that our net assets per share have significantly recovered to 40 pence from 32.1 pence this time last year. And again, as Mark has mentioned, we have very strong liquidity on our balance sheet now for investment and other corporate purposes. And again, with our strong cash generation, we are able to recommend to shareholders a final proposed dividend of 0.3 pence per share. This next slide summarises the movements in our assets under management from the beginning to the end of the year. And what you can clearly see here in the performance column is the very strong recovery in the values of our portfolios, led by our 3 excellently performing VCTs. And that's taken us 18% up to 940 million, just under the billion target that was set 2 years ago. The next slide presents the income statement under IFRS, International Financial Reporting Standards, and so therefore the revenue number here is higher than the 19.2 million. That, of course, is because the gross performance fees are included in this top line. But the rest of the numbers, hopefully in that table, should be familiar to you. And at the bottom, as you can see, is the 34.5 million post-tax profits. We continue to be non-tax paying, and we continue to have tax losses. Lastly, our very strong balance sheet now is dominated by the portfolio of the investments, notwithstanding the 4 exits that we've had in the year, at just over 96 million, and of course also the very strong cash balance as well. And in our cash flow statement, you can see the top line there. We do generate cash as a trading business. We're not just reliant upon our trade exits to generate cash. Thank you.
Okay, thank you, Martin. So my first slide really shows how and where we invested 95 million across the year. Also shows the split of our 940 million of assets under management and the significant liquidity that Mark was talking about. So we have talked before about the importance of investing through the cycles, and we did that last year, investing in 76 new companies, 173 in total. Many of those new ones were in our debt division, where we achieved CBILS accreditation during the summer period, but also 26 new venture deals. And we worked really hard on the origination piece again during last year. A lot of efforts around our digital engagement platforms, webinars, outreach, meet the funder type events, and that's really enabled those new deals. So into our private equity division, we really focused on our portfolio. In the period, the start of the year, we saw increasing activity, and we're now in the position where we are close to completing a couple of new deals in that division. And I guess to finish on this slide, I'm really pleased with the significant liquidity that we have, and that will enable us to continue to make good investments going forward. Okay, this next slide shows the geographic split of those 173 investments that we made. As you can see, a wide spread across the UK regions, but concentration in Mercia's heartland, which is the Midlands and the north of England. And the spike, or the larger bar, Yorkshire and Humber, does reflect those contribution from our debt deals that we've done. So last year was a really successful year for exits. So 10 profitable exits across the group, as Marcus said, compared to 5 in the previous year. Those exits returned over 100 million back to our investors. 37 of that came back to our balance sheet. Now, clearly, successful realisations are key to our business, but that's by no means the whole story. So as Mark has already said, we do need to buy well, hence the focus on origination, and manage well as well. And the assets on the left-hand side here were all very early stage investments, or indeed startups when we first invested. We've helped with advice around strategy, input on recruitment and shaping those businesses along the way, and indeed help at the point of exit itself. The right-hand side shows the great year that our VCTs have had. Standout performance there is from Agilitas, which was sold to private equity, given an 8x return. But those realisations have continued this quarter as well, the largest being Music Magpie, which listed on AIM in April at 12x cost, and our VCTs sold half the stake. They're returning a further 25 or so million back on that one as well. Okay, the next slide shows the summary performance across our equity classes. And just to bear in mind, we operate some 40 funds, various ages, various sizes, remits, and geographies. And we use TVPI as a measure. And you can see we're showing some good performance here. We expect these percentage numbers to increase over time, acknowledging also that the newer funds, we expect these numbers to be lower and below cost in the early periods, given the fee drag and the effects of the J curve. Also to note, our retail funds, our EIS funds, the figures quoted here, do ignore the substantial tax benefits as well available to the investors. Into our VCTs, again, we're showing some really top quartile performance here. The total returns include cumulative dividends to date, and I guess the really interesting thing is the NAV growth seen. So we're showing some really strong performance over 12 months, but also I guess more representative is the 24-month numbers, which are showing 13 to 16% increase, I guess, before and around the pandemic. Okay, next slide, we are into our proprietary capital, so our balance sheet. So 23 direct investments now, 2 new added in the year. As Mark said, we have had 4 exits, 37 million of cash generated from those exits. providing 20 million of gains, and our proprietary capital is currently delivering an IRR of close to 15%. That's measured on a portfolio basis. And again, that's through our continued investing activity in those areas that we have always invested in. So in terms of investment focus, clearly we'll continue to support our portfolio. We've got some really exciting assets in there that are maturing well. We also have the firepower now to add new deals with some 400 to select from, and we're carefully monitoring a number of those. Some logos down below, and those kind of are from software in Pimberley to kind of deep tech, Tribosonics, and life sciences with new cells. Now, we're already an LP investor in our current funds. We'll also look to seed new funds as we grow our funds under management. And we're also seeing some opportunities to provide that total capital solution alongside our funds to provide some cash out, possibly to exited founders or indeed existing managers in deals. And this is quite interesting for us because many funds just can't do this. So these are 3 profitable exits from our balance sheet last year. Now, all 3 of these are different. There were strategic acquisitions for the buyers. So Native Antigen Company was sold in the middle of 2020, Clear Review in the autumn, and then our largest exit to date in the spring, where we sold Oxgene to Wuxi in a just under £100 million deal for a figure that represented something like 16 times revenue on that business. So all 3 sales above carrying value and at significant multiples for both the funds and our balance sheet. Okay, so this slide really does show in numbers the story of the year. So on the left-hand side, starting with a portfolio value of 88 million, to which we added a further 15 of new investments. Next 2 columns show the 37 million of cash returns and the P&L effects of that. Together, those 2 columns mean that 17 million of brought forward value has been effectively removed from the portfolio. The next column is our fair value uplifts, so 10 million pounds of movements there, and you'll see that the largest movements really across 6 assets. Those movements are reflective of third-party indicators of value and clearly of the progress made across a number of those assets. Impression Tech, also, we did purchase a co-investor's share at a favourable price, and My Health Check, which is an AIM-listed business, its share price has recovered from sub 1p to over 4 pence at the end of the period, and that's really changing, widening the focus of that business and also reflecting some management changes. And that leaves us with a portfolio of 96 million at the period end. Okay, so a little deeper look at our top 10 holdings. So just to recall, we do look to build our stake over time, so some substantial holdings there. We do look also to take board seats across these assets. And the main message here is that there's been some significant progress across all of these assets. And that's measured in terms of growth in revenues, new license deals, partnership deals in the case of Impression Tech and MedHerent. Just to spend a little bit more time on our largest asset, which is nDreams. So some very strong revenue growth, and this is our VR games developer. So the revenues have not just been from work for hire contracts, significant increasing amount of actual games revenues. We are now selling above 100,000 units of two games, Shooty Fruity and Phantom, both on Quest. The Quest headset. The company's next game, which is called Fract, is due out in August, and that's on Sony's PSVR console. So also, just to note, in the year we signed our first third-party publishing deal. This is where we've partnered with an indie developer of games, and we will publish that game in return for a revenue share as it's launched. So just to touch on a couple of others, in Technica, which is our e-commerce efficiency and security business, some very strong growth in the consultancy part of that business, up to now 10 million of revenues. And MERCIA, the bot management side, again, is doing very well, 3.5 million or so of dollars of ARR, and some exciting new customers added. BoxPopMe, our video analytics business, is growing strongly. It is now also, interestingly, re-signing customers that churned during last year, and is doing very well. Impression Tech is an asset looking at the automotive sector, so lightweighting of aluminium. Again, now has 4 licenses covering US, China, and Europe, and seeing some significant inbound interest from OEMs. Medherent in life sciences is doing very well as well. New pharma deals across the period. Okay, so the second part of our top 10. So Faradion is our sodium-ion battery play, and again, the progress really is significant here. So some technical progress made where energy density and cycle life is now very comparable to other technologies, but more importantly, it's now into revenues and shipping battery packs. So, huge market opportunity here, and we're happy with the progress. Intelligent positioning, again, is an asset where we did take an impairment in the first part of last year, as we saw some churn. That thankfully has now stopped, and we're back into growth. My Health Check, excuse me, I've already just touched on that. But over the course of the last year and into this year, they've made 2 acquisitions and really changed the focus of that business to be helping you take control of your own health. And we've now stepped off the board of that business. Warwick Acoustics is again seeing some deeper and wider OEM engagement. The existing OEM relationship is really looking for weight saving in the cars of the future, range extensions, and for sound quality of its speaker systems. And last but not least, Soccer Manager, which is another games business, seeing some strong growth, and we have the launch of the 2022 game coming up in September, and again we're hoping for some incremental growth again, given some further licenses that we've in the process of securing for that business. Thanks, Mark.
Thank you, Julian. The next slide quite rightly says responsible employer, responsible investor. MERCIA is a services business, a people business, and we are dependent on a high-quality team here operating at MERCIA, about 100 people across 8 regional offices here. And because of that, we look towards things that focuses and aligns their activities and also retains these good people as we start to develop them and train them within MERCIA. We have a dedicated ESG team we have had for some time, and that has representations from all parts of the group, led by Jill Williams, and that group reports into myself. And that group is guided by the UN Principles of Responsible Investing, and there are a number of facets to that, but the important focus for this particular year is one of diversity, both within MERCIA and within our portfolio. And just building that out, looking at our entire staff, 36% of our staff, 17% of our investment team, and 40% of our board are women, which for the financial services is good, but personally I think needs work to be done, and that is a strong focus in one aspect of diversity. There are other aspects of what we're doing here in terms of further developing the team as we continue to grow the business. We have a thing called MERCIA Spirit. That's where we're dedicating our own time towards initiatives such as cancer research, and a thing called the Skills Builders partnership, where we work with schools and helping them understand financial discipline, etc., and what it means if you were to start your own business, for instance. Other things that we're doing like MERCIA Knowledge and MERCIA Academy. MERCIA Knowledge is connecting up the various databases that we have within the business and AI systems within the business, connecting those up and joining those across the group so everyone can input and access that information. The MERCIA Academy is a training system supporting our staff develop as we continue to grow as well. And in conclusion, just to summarize these results, we've had a very strong year, but this is very much the sort of, as I've heard Martin say to me, the end of the beginning, but the beginning of much, much more. And there's more to come from this group. The strategic targets that we selected back in 2019 have been met a year ahead of plan, and we've withdrawn now to the MERCIA 2020 vision, and there's a couple of questions on that we'll talk to in a moment. The fee income of the business, of the fund management business, I think is important to dwell on. 85% of that is contracted and recurring, so a good long sight of future income, and that underpins our progressive dividend policy. And that's important because a number of our funds are either evergreen or long dated, 10, 12-year funds. So that fee income goes out many, many years. Assets under management growing, 940 million up from 800 million, growing predominantly on an organic basis in that period. And a lot of free cash across the group, but not too much. That reflects the opportunities, the investment prospects we've got, as well as the existing portfolio as we look to grow our presence, grow our portfolio size, and grow our portfolio value. In respect to the direct investment portfolio, that is maturing, starting to deliver exits, 3 profitable exits from the balance sheet, 10 across the group in this period, and we expect that to continue. And that all underpins our firm belief in the business and our statement in terms of taking the interim dividend 0.1 pence up to the prelims level of 0.3 pence per share to a total 0.4 pence per share for the year. Thank you very much for your attention.
That's brilliant. Mark, Julian, Martin, thank you very much indeed for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those questions submitted already, I'd like to remind you the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Mark, Julian, Martin, if I could ask you just to have a look at the Q&A tab, you'll see there's a number of questions that have come in. If I could just hand back to you and ask you to read out the question, if you would be so kind, and give a response where it's appropriate, and I'll pick up from you at the end.
Brilliant. Thank you very much, Mark. And everybody, what I've done is I've just grouped them together, and then I'll pass them amongst Julian, Martin, and myself to answer. There was one question we received in respect of whether or not we had a regret in terms of the NAV impact on the VCT fund management contract acquisition. I'd just like to pass that over to Martin, actually.
Yes, thanks, Mark. I thought I'd perhaps provide some comparable facts between where we were before the placing and the acquisition in December 19 and where we are today. So if we go back not that long ago, some of you may recall that the share register and the dominance on the share register of one or two institutions, and we only had a free float back then of 28%. And you'll see today that the free float is at 69%. back then, NAV per share was at 42.3 pence, and today we're at 40, so we are within spitting distance of getting back to where we were from a NAV per share basis. However, if one then looks at other metrics, performance metrics since then, obviously we weren't profitable back in December 2019. We were on a run rate of losing £1 million a year, what we used to call net expenses, whereas of course now we've declared adjusted operating profits of 3.3 million. And because we were not profitable at the adjusted operating profit line, we were not dividend paying either. Whereas now, of course, we're able to recommend the payment of not just the interim, but also a final dividend. We weren't receiving performance fees in December 2019. And of course, this year we've been able to report 3.8 million of performance fees, largely coming from those acquired VCTs. And we weren't at critical mass. We had 490 million of assets under management, which has now grown by 92% to 940 million. So in many respects, we would argue very strongly that in fact the fundraising, discounted though as it was at the time, has resulted in a considerable progress for MERCIA. And I think finally that's reflected in today's current share price, which at 37.5p is only at a 6.25% discount to NAV per share, whereas back in December 2019, just before the placing was announced, the share price was at 32 pence per share, but that was then a 24% discount to NAV.
Thank you, Martin. And Julian, there's a question here with two parts to it, which one part I'm pretty sure you won't be able to answer or not allowed to answer. But the question is, where are the next direct investment exits coming from? And do we sell 100% of our holding at exit?
Yeah, thanks, Mark. So you're right. I can't give a specific answer to the first part of that question. I guess what I can say though is we certainly are expecting exits over the course of the next 3 years, and that's really why we are comfortable with the 2020 plan and of course evergreening the balance sheet. I can also say that the 3 exits that we have had in the year are all strategic ones for the buyers. So they are looking for expertise, perhaps intellectual property, and the growth potential for those assets, not necessarily profits. So if we look across our portfolio, we've got the likes of Voxpop.me and Technica, Endreams, all in markets that are growing extremely fast, and in markets where there's significant corporate activity. And I guess if you look a little bit further out, we are starting to see some of the OEMs taking a look at what is required for 2030, kind of electric revolution, etc. So there's inbound interest for the likes of Faradion, Impression Tech, and Warwick. So that's a long answer to your question. Hopefully I've given you some flavour. And do we exit all of an asset in one go? And I guess that depends, because we certainly did completely exit those 3. As I've said, our VCTs have exited partially or indeed half their holding in Entertainment Magpie, and indeed that's how we ultimately exited from Blue Prism, where we sold progressively over time. So I suspect in the future we'll see a combination of all those things happening within our exit landscape.
Thank you, Julian. Another question was in respect of the MERCIA 2020 vision and what makes up the 20 million pre-tax profits. And if I pass that to you, Martin.
Yes, the question is it a sort of the profits, is that a good idea for MERCIA? And I think perhaps the best way to summarise it is if we can achieve, all other things remaining equal and just putting future dividends to one side for a moment, if we can achieve an increase in 60 million of NAV over the next 3 years, that will equate to a further 13.6 pence NAV per share. And if one believes in a strong correlation between NAV per share and our share price, then shareholders should be rewarded by an increasing share price over the next 3 years.
Excellent. Thank you, Martin. And just to remind everybody that that's a 20 million pre-tax profit on average over the 3 years, and that's made up of a number of things such as realised gains, fair value movements, obviously the operating profit from our fund management business, and periodically performance fees. And because of the unpredictable nature of all those, although we expect over 3 years to achieve that any 1 year may be above or below that number. Another question, sorry Martin to pass this one back to you, but another question was of the tax losses that we're carrying at the moment, how far into the future do you think they'll take us?
Well, that's an impossible question to answer for the following reasons. One is because we don't know what the Chancellor will do in the future in terms of tax legislation to recover obviously all the borrowing that he's had to put into the economy, and although he's announced movements in the future in corporate tax rates, we don't know what other things he may do around accumulated tax losses brought forward and so on. The second point I'd make is that our taxable profits really fall into two categories: the profits that we make when we sell investments, and the profits that we make from our fund management trading activities. And we, as a business, qualify for what's called substantial shareholder exemption. And if the businesses that we've invested in also qualify, then when we do sell those investments at a profit, there is no tax to pay on those gains. One can only test at the point of exit whether each of your investments do qualify for SOC. And so it may well be in the future that depending upon which assets are exited next, they may or may not qualify. But assuming that they do, then we do have 2 or 3 years of brought forward tax losses, which could be used solely for future profits from our fund management operations.
Thank you. And there's been a number of questions about the AUM growth going forward as well, and where that will come from. And I think it's important to note that AUM growth is delivered really by two parts of the business. It's obviously the funds under management, and it's the performance of the direct investments. It's the combination of those two. And in terms of fund under management, what drives that is track record and people. And we've got good track record across private equity, across debt, and across venture in a number of those asset classes. So that track record and the people associated with it will drive organically our fundraising ability. We've also got an extremely good track record of making good value creative acquisitions, and that is something that we'll be focused on too. So AUM growth in effect will come from acquisition, it'll come from organic fundraising, it'll come from our direct investment performance. So I hope that addresses that one. Sorry, forgive me, I'm just making sure we've covered off. Actually, there is a question that's just come through about COVID government support in our portfolio and whether the withdrawal of that, and said over the year end, do you expect its withdrawal to have an impact during this year? And the answer is no. So we access the future fund in a number of our portfolio at the beginning of the year, beginning of the financial year. Our portfolio is well financed, and we have, as I've already mentioned, 14 million pounds of unrestricted cash across the group. So we are adequately financed to support our portfolio. So no, the withdrawal of that has not had an impact on us, and our portfolio has predominantly not been impacted by the major sectors that have been hurt during this awful period. And then the final question, I guess, is aspirations for future dividends.
Yes, and in that respect, the aspiration is to increase the dividend year on year. There was an earlier question which perhaps I could also address, which is around a question about why was the fundraising in the year relatively small?
Yes.
And that's for a number of reasons. I mean, first and foremost, we did raise 13 million in new EIS funds. But if you look at then at the other major classes of assets that we're managing, they tend to go in cycles. So, for example, one of the reasons we have so much liquidity in our funds, in our venture funds at the moment, is because we are in the investing phase of some of those British Business Bank funds. And so, whilst in that first 5-year period, it would be unusual for major new funds to be launched. Secondly, although the venture capital trusts that we manage do typically, as the whole industry does, typically raises funds almost every year, our own VCTs, with their recent successful cash exits, were already sitting on substantial funds and therefore made the decision not to raise any additional capital in the last financial year. So that was really the main reasons why our new funds under management raise was quite small. And of course, also we were very much focused on preserving value in our portfolio companies in the last 12 months while we were fully sort of locked down. Looking forward to the next 12 months, I'm sure we'll see some growth in new FUM from funds raised.
Thank you. And I've just also noticed that there was a question with a number of questions, of which one of the question was, if your balance sheet's maturing so rapidly and you're generating exits and more cash, surely you should be returning cash back to investors or share buyback.
Yes, and obviously we've looked at a share buyback calculation, but in fact, particularly with the closing discount now to NAV per share with the share price, if one, say for example, spent £10 million on a share buyback, it would only move the NAV per share by half a penny. And if one believes that the share price is linked to NAV per share, then that would be a very, very small movement in the share price for shareholders, whilst essentially getting rid of almost 20% of one's firepower. So for that reason, and because we do believe we have far better uses for that money, our board does not have any plans for a share buyback.
Thank you, Martin. And I'm hoping that the audience today will have seen with a shadow portfolio of something like 17 businesses we're tracking on the balance sheet, a number of opportunities in terms of expanding the group further, the fact that our balance sheet capital can seed and grow funds under management as we look into new areas, that the management team and board have ample use of the capital that it has on hand and see that more as security and opportunity to grow.
Another question.
Oh, well, we're trying to keep up with your questions, but it's great to get. The question is, how is competition in your market affecting the prices that you are having to pay? Julian.
Yeah, so I guess that's an interesting question. So you know, we are seeing some prices that are in excess of perhaps the ones that we'd like to pay. So you know, that certainly is happening. You know, what we are trying very hard to do is where we can not compete on price, but really kind of tell and show budding entrepreneurs that the benefits of MERCIA, because it's not just about simply the money. It's about you know, access to the talent functions that we have, you know, in terms of helping those businesses grow and strengthening their teams, the venture partner input that we can provide, in our own track record, which is good because you know, that shows entrepreneurs, you know, in partnering with us, they've got a good chance of being successful. So yes, we are seeing some competition, but you know, we have some very strong answers to that as well.
And you know, if I can just add to that, which is back to my, and forgive me for sounding so boring, is the responsible employer, responsible investor. But the reputation, the brand reputation that we have in the market is strong. And we have serial entrepreneurs, and Oxygene is a great example there, where Oxygene wasn't the first business we backed as the co-founders, but the third business we backed as the co-founders, the second business being Native Ancient Company. So those serial entrepreneurs come to us as a first choice, and we become the first choice investor. So it isn't anymore a simple point of I've got money, do you want money? It's actually I've got resource, I've got experience, and I've got understanding of what it's like to build a business in a difficult dynamic environment. And that really helps us win deals.
Mark, thank you. It might be an opportune time for me to jump in. Obviously, you've been very kind and answered pretty much every question that's come through, and for all those investors that have submitted questions, thank you once again for your interest. And perhaps, Mark, ahead of me diverting investors to give you feedback, I could ask you for a few closing comments before doing so, and then I'll take the floor back from you.
Thank you, Mark. Well, I'm hoping these results demonstrate the power and strength and scalability of what is our hybrid investment model of managed funds and proprietary capital, with a focus exclusively on the UK and predominantly across the regions. Over 90% of our investment activity is outside of London. And really all I can say is expect more to come. We expect more investment activity, expect more AUM growth, expect more profitability, and expect that progressive dividend policy to deliver. And thank you very much for those that are part owners with us, and we look forward to updating you in the coming periods.
Mark, Julian, Martin, thank you once again for updating investors. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of MERCIA Asset Management PLC, we'd like to thank you for attending this afternoon's presentation. That now concludes today's session, and good afternoon to you all.